Chapter 10 introduces the metrics we'll use to evaluate a project's cash flows. In the first segment of this chapter, we'll look at an overview of the capital budgeting process, the vocabulary, and 3 of the major methodologies used to evaluate potential projects. In this chart, we're now focusing in on the central piece, evaluating cash flows. Capital budgeting is critical to a firm's future. It involves the analysis and selection of future projects. These are long-term decisions, typically involving large sums of money that would be hard to reverse. These choices define the strategic direction of the firm. The techniques learned in this chapter apply to all sizes of decisions, from replacing a piece of equipment to acquiring a firm. The methods are the same, only the scale is different. The steps in capital budgeting include estimating the cash flows and assessing their riskiness. We'll address that in Chapter 11. Determining the appropriate cost of capital. We just did that in Chapter 9. Evaluate the cash flows by finding the NPV, IRR, etc., and deciding to accept or reject. That's what we're going to learn in this chapter. Potential project decisions facing a company fall into many categories, with varying levels of risk, even within the same firm. The easiest project to analyze is a start-from-scratch new business, which will be our major focus. Once the basics are learned, they can be modified and applied as necessary for other types of analysis. We need to make sure we're clear on some basic definitions before we continue. In making investment decisions, it makes a difference if projects are independent or mutually exclusive. The terms mean exactly what you think. Looking at a set of independent projects, you may select all, none, or any subset. With mutually exclusive projects, accepting one means automatically rejecting the other. To do this, you must be able to rank the projects from best to worst. Most projects will have what are termed normal cash flows, meaning a cost or negative outflow in year 0, followed by a series of positive inflows for the rest of the project's life. Non-normal cash flows involve more than one sign change, meaning more than one negative cash flow over the life of the project. Examples include a nuclear power plant or a strip mine. We'll look at one of the examples in this chapter. In a mini case, we're presented with 2 projects, S and L. Both cost $100 to launch. Project L's cash flows grow over the 3 years of its life. Project S's cash flows start high and decline. The first method we'll cover is net present value. NPV is simply the sum of all the discounted cash flows of a project. It's net because you're netting out the PV of the inflows against the cost to start the project. Since cash flow 0 is frequently negative, the second version of the formula is usually the case. An important note, the Excel NPV function was built in error. Too late to change it now. It assumes the first cash flow given in a range is considered by Excel to be cash flow 1, and it is discounted. You must handle cash flow 0 outside the NPV function. To find the NPV for Project L, we discount each cash flow back to time 0 and sum them up, netting them against the $100 cost. The NPV for L is $18.79. For Project S, $19.98. In your calculator, use the CF worksheet as we learned in Chapter 4. Note the example of the Excel function in the red box. Inside the function parens, we give it cash flow 1 to cash flow N, and then add back cash flow 0 outside the function. If you need to review using the cash flow register in your calculator, take a minute to go through this and reacquaint yourself with the enter and down pattern. We'll be using this a lot in this chapter and the following chapter, so you need to be comfortable with it. And there's a video tutorial on calculating NPV and IRR in the TI Business Analyst 2, posted with this unit. The NPV of a cash flow stream is simply the present value of the inflows minus the cost. The metric for NPV is dollars, and it directly indicates the expected net gain in shareholder wealth if the project is taken. The decision rule is simple. If NPV is greater than 0, accept the project. You can choose between mutually exclusive projects on the basis of NPV. The larger the dollar NPV, better project. The NPV method has the following strengths. It considers all the cash flows, meaning it uses all the data you've got. Time value of money is used. You can rank projects. It is directly related to the gain in shareholder wealth. It is the dominant decision criteria. It always prevails. Looking at the NPVs of the projects, S's NPV was 1998, L's is 1879. If the projects are independent, you take them both. If they're mutually exclusive, take project S. Note that the NPV is dependent on the cost of capital. Closely related to NPV is the internal rate of return. IRR is the discount rate that forces NPV to be zero. Here you can see the formulas for NPV and IRR are the same. We're just solving for something different in each case. The problem with finding IRR is that you're trying to solve for the root of a polynomial. You can do it manually and iteratively, but your calculator in Excel do it in a heartbeat. The yield to maturity on a bond, which we talked about in the earlier chapter, is the bond's internal rate of return. To find the IRR for project L in your calculator, you enter the cash flows as you did for NPV and press IRR. If you haven't cleared your calculator from calculating NPV, they're still in there. Just press IRR. The rationale for IRR is that if the internal rate of return is greater than the firm's cost of capital, the project should be accepted. The IRR for project S is 23.56, for L 18.13. If S and L are independent and the cost of capital is 10%, you take them both. If they're mutually exclusive, you take S. A key point is that IRR does not require a cost of capital. It doesn't use it in the calculation. You compare to it. The IRR does have strengths. It does consider all the cash flows. It is a time value of money method. It does provide some indication of risk. Consider, if your cost of capital is 10% and you find an IRR of 25%, you have a lot of room to be wrong and the project can still be profitable. If you find an IRR of 12%, you're close. That's risky. IRR is preferred by executives who like a rate of return. However, there's some problems with IRR. You cannot use internal rate of return to rank mutually exclusive projects. A 10% internal rate of return on $1 million project is far better than a 25% return on a $1,000 project. We'll look at the multiple answer problem in Part B. IRR assumes cash flows are reinvested at the internal rate of return, while NPV assumes reinvestment at the weighted average cost of capital, which is more reasonable. The IRR assumption causes the IRR result to be biased, up if the IRR is greater than the cost of capital, down if it's less. With constant cash flows, meaning the same each period, you can use the rate function in Excel or solve for IY in your calculator as though you were solving for the yield to maturity on a bond. We can demonstrate one of the problems with internal rate of return with this example. The slide shows the NPV of S and L at various discount rates. Note that at low discount rates, L is better, but at high rates, S is better. Graphically, you can see the shift. At a discount rate lower than the crossover point, there's a conflict between S and L. Above that point, no conflict. There is no conflict for independent projects. For mutually exclusive projects, the conflict can cause problems. If the discount rate is less than the crossover rate, then NPV and IRR indicate different choices. If the discount rate is greater, then there's no conflict. To find the crossover rate, compute the difference between the cash flows of the two projects. Doesn't matter which way you subtract. Enter these differences in the cash flow worksheet and solve for IRR. In our example, you'll get 8.7%. If the profiles don't cross, you get an error. There's no conflict. You'll see this on the next slide. We're subtracting L minus S. Enter those in your cash flow worksheet, solve for IRR, or use the Excel IRR function. So why do they cross? Two main reasons: scale differences and timing differences. The timing differences has been demonstrated with S and L. S's cash flow started strong and declined. L started slowly and grew. This ends Part A of Chapter 10. In Part B, we'll move on to cover 3 more techniques as well as some special cases.